The reason why I wanted to get you on board here was because you and I share a lot of similarities with respect to investing practices, I guess you could say, in terms of different ideologies. You've actually, for all intents and purposes, reinforced some of my, uh, you know, I guess confirmation biases, if you will, while also kind of opening my eyes to, hey, these types of models actually would work. And one of the reasons why, as you know, when we spoke over the weekend, because you do come from, like you were mentioning, big private equity, and you started your own you started your own investment office, or whatever you call um, those smaller form investing, you know I guess offices, for lack of a better term. um, but it's also very different from what I see out in Twitter and a lot of other takes that I routinely see. So I mean, maybe quickly get into how you got started with respect to real estate. Get into what you learned from being in the big private equity space. What the takeaways were. What you've and it, I guess explain what the benefits that you learned from being in big private equity, and the negatives that you extracted from, or you pulled out from your uh, applying to your own investment strategy, going on your own. So I'd love to know, I guess, the pros and the cons of big private equity, and what you took from big private equity, applied it to your own investment strategies, and then what you didn't want to take from private equity, and what you don't apply to your own investment strategies. Those are a couple things that I'd love to learn right off the hop here.
Sure. Yeah, I can get into it. So basically in college was looking for a job, obviously, basically an internship, end of sophomore year. Right. And everyone was doing that kind of corporate recruiting. Wasn't for me. I wasn't going to get in a line and be the 100th guy to talk to Goldman Sachs, So I ended up getting an internship on campus. Basically, it was almost like a job site for entry-level jobs. And became pretty good friends with the CEO, who had exited a few businesses beforehand and was actually really successful. And like one day we were just kind of having a drink on Friday night, and he's like, "What do you want to do?" I was like, "I want to work in private equity." He goes, "All right, one of my good friends in business school runs a real estate private equity firm. You want to interview there?" So I was like, "Sure." So interviewed there. I think got the one technical question they asked me about real estate completely wrong. Ended up talking about fishing a bit with one of the guys, and I guess he just liked me and got lucky, got the internship. And then just worked like a dog to get the return offer. So that's how I got into the space, kind of fell into it. I always knew I wanted to do something on the finance side and really private equity side, but didn't really know it was going to be real estate too much until it happened. To give you some background on the firm, basically middle market private equity firm. So big by some standards, small by other standards, obviously not Blackstone, not Starwood, not anything like that. But we worked in a pretty decent size range, usually buying deals like between 50 and 100 mil, around there. Sometimes up to 200 mil was kind of our mandate, but nothing really below 20 mil.
For a little bit of context for people listening, what would a 50 to 100 mil deal get you in your space that you're planning? How many doors, location wise?
Yeah, so I focused mainly on office and hospitality.
San
Francisco.
Right, yeah.
Back then, you were probably looking at $750, $800 a foot.
Okay.
So that's kind of what we were buying there. Mostly boutique office buildings, not massive high rises, usually maxed out around 20 stories or so. Obviously, depending on the floor plates. But yeah, I mean, in terms of the lessons I learned from it, I think that's kind of the interesting thing. I basically learned that, and I'm sure some people will dispute this, but I think it's almost impossible to do more than 2 to 3 kind of great deals a year. I think most shops that are pumping out more than that are relying on the market, right? So you have shops that they're making a bet on the market, and they're buying at market rates, and maybe the market goes up and they do well. Maybe it stays flat and does mediocre. Maybe it goes down and they do poorly. right? But I think it's very, very difficult to find more than 2 to 3 deals a year that are actually good deals where you're the one adding value, where there's operational expertise and where you're actually kind of getting alpha there. On the other hand, I do think it's extremely easy to buy deals at the market price and create a firm that makes money off asset management fees, which is what most of those firms do now. So I think those are kind of the two business models. One is, look, we're going to do a few home run deals a year, and we're going to make our money on promotes. The other is we're going to amass a very large AUM. We're basically going to make bets on the market we're investing in, the asset class we're investing in. Maybe there's market rent growth, maybe there's population growth, whatever it is. And we're going to build a really high AUM base and make money off asset management fees. And those are
let's explain the promote for people that don't necessarily understand what you're referring to on how you make money on the promote.
Sure. So basically the promote is the real estate private equity firm's share of the profits in the deal. Typically they'll put in 10% of the equity and get 20% of the promote on the back end. So basically, let's say there's a $100 million deal you did, right? And you 2x your money. So you get 200 mil out at the end. 100 mil of that is your initial investment. There's 100 mil left. You would make 20 mil, 20% of that as profit.
Got it. Perfect. Okay. And then AUM is assets under management.
Assets under management. Yeah, exactly. And typically a private equity firm, depends how big you get. The bigger you get, the lower percent fee you take. But anywhere from 1% to 2% of committed equity you would take on a yearly basis.
Now, on these private equity firms, do you usually, when you were in private equity, essentially, would you see them doing both?
I think some people thought they were doing both. I don't think really, no. I would say most of the time you're either doing a few deals a year that are high impact, or you're just in the capital deployment business. And some people thought like, oh, we're buying 15 deals a year and they're all great deals. And I mean, they're not going to be great deals. I think there are very, very few firms that do that. There's obviously a few that can pull that off. The majority of people aren't doing that.
Interesting. Very cool. Okay. So what did you pull away from big private equity, and what did you like about big private equity, the way they did things, and what did you not like about the private equity world?
So I think the biggest thing you learn is how to structure and underwrite deals, right? I think that is by far the biggest benefit. I think if you go to any sort of sub-institutional market, let's call it sub 20 mil in a non-primary market, almost no one knows how to underwrite correctly, right? You'll say stabilize, ask a broker what stabilized yield is, they won't even know, right? So they're not even marketing the deals correctly. I think the structure too is really important. Understanding the capital stack, understanding how to finance deals, understanding what you can negotiate, what you can't, how to read loan documents, what to have in a PSA, just everything like that is really, really helpful. Just a formalized skill set. That I think is the best part of the institutional private equity world, where you learn that and you have an edge over almost anyone when you go to an asset class that's smaller and a market that's smaller. Interesting.
Very cool. You want to get into, a couple high level, firing off a couple examples of what you're referring to there?
Sure. So at a basic level, right, I think most people understand what a cap rate is. And usually that's what properties are marketed off of, right? But the average person thinks that the initial cap rate, basically the price you buy the deal at and the income you buy the deal at, is the most important, when in reality that almost doesn't matter at all, right? What matters is the back end, right? Where are you stabilizing? And that's what the stabilized yield is. It's basically your NOI divided by all your costs in the deal. And you typically need to get that to usually at least 150, 200 basis points above your market cap rate to really get a good return on the deal. And most people don't get that at all. They'll look at the in-place income. They think they understand the stabilized side. They don't. I see it all the time. I teach tons of people. I've obviously have followers on Twitter and deal with it all the time, from even professionals who will DM me and they'll be like, oh, I'm looking at a deal like this. Is this right? And it's like, no, it's not. So it's seriously people running a lot of other people's money who don't know what they're doing.
Interesting.
So it is actually, the funny part too is it's a very simple concept, right? It's not hard at all. It's division. But people just don't get it.
Interesting. Very interesting. So yeah, walk me through a couple of the other examples that you were mentioning, that you pulled away from private equity on how a lot of people don't actually understand how to, underwrite these deals? Like give us a quick crash course on how a pro like you would essentially underwrite these deals.
Yeah, so there's a few things you want to focus on, right? The in-place income, basically all you're focusing on there is the DSCR, and that's your debt service coverage ratio. And that's because the only thing that matters in the beginning is for that initial income side is who's going to finance the deal, right? And if your DSCR, which is basically your NOI divided by the debt service, is on a yearly basis is above 1.25x, you can get bank financing. If it's below that, you're going to need different type of financing, right? And that drives a lot of the capitalization decisions, because obviously if you're looking at a deal and you can't get bank financing, you're gonna have to turn somewhere else. And typically that's more of a short-term loan, right? Maybe it's a bridge loan, maybe it's hard money, kind of function as the same thing, but it's usually higher interest with a shorter term, which elevates your risk in the deal, right? Anytime you have shorter term debt or higher interest debt or even floating rate debt, that really, really increases the risk profile. And that's one of those things that I think people overlook a lot, right? Because if you just take a real estate deal and you say we're going to go in unlevered, for example, it's almost impossible to go bust. It really, you have to be incompetent to go bust on a multifamily deal that has no leverage on it. You have to be beyond incompetent. So really the only risk is adding the leverage. And really the risk of leverage isn't the interest rate as much as it typically is the balloon payment that comes due. So when you take on shorter term bridge debt, you're really compressing that timeline and adding a lot of risk to your deal because you have less time to figure it out before the balloon payment comes due. So that's kind of the first thing is you really worry about at the initial income side. You're not worried about the valuation. You're worried about the capitalization. Then when you move over to the stabilized side, it's all about stabilized yield, right? And you're looking at the stabilized yield. You want to get it to at least 200 basis points above the market cap rate. Personally, I look for 300 basis points plus because I'm looking for higher impact deals, home run deals. And that's a large part of the analysis, right? The next things you'll start looking at, you'll look at the basis, right? So this is just looking at comps. What's the price per square foot? What's the price per unit that comps sell for the area? Not only is the price you're buying it for, but the price you plan on selling it for, is that below the average comp number, right? Because if you plan on selling it for below what deals are selling for today, that's probably a great deal, right? Because you're selling it 3 to 5 years in the future. So basic stuff like that, it's really, once again, these things aren't difficult. What's hard is actually creating these standards and then sticking to them. Because real estate math isn't difficult, running comps isn't difficult, stabilized yield isn't difficult, and really thinking through capitalization isn't that difficult. It's kind of putting it all together and making sure that the risk profile of a deal makes sense, and that when you're going from in place to stabilize, you're taking an appropriate amount of risk for the reward you're getting.
Now, let me ask you this: for the stabilized yield, how are you estimating that? Is it a combination of we have to invest X amount of capital to get these units up to standard, then we're going to get X amount of rent, which is going to give us a return on investment of Y? Is it something like that? Or like, how do you get accurate figures for stabilized yield?
Yeah, so that's a good question. First off, you run it off the market rent today, right? A lot of people will run it off the market rent 5 years in the future, which is, you're just betting then, right? You're betting the market's going to increase. Yep. So it's called untrended then, but you'd run it off the untrended market rent, which means the market rent today. That's the first thing. The second thing is, yes, basically you look at the return on cost of everything you're doing. So let's say that, I'll just run through some basic math, right? Let's say the property is currently, the current rents for the unrenovated units are 1,000, right? And you could put in 15K and that's going to increase the rents by 200. Right. So basically what you do is you would do 200 times 12, right? It's 2,400. And let's say the renovations cost 15K, divide that by 15,000. That means your return on cost of doing that is 16%. So if the market cap rate is less than 16%, then you do the renovation. If it was the other way around, and let's say the return on cost was 5% and the cap rate was 7%, you'd literally be losing money by doing the renovation. And that's another thing a lot of beginners don't get, is they think, oh, whenever I renovate, I'm adding value to the property. You're not. You could easily have a renovation where you're losing money.
And that's a great point. And you're saying that because if you had $200 a month in rent times 12 divided by the cap rate, you're adding more value to the property per unit than it's costing you.
Exactly. Yeah. You're adding more value than it's costing you. And you're also weighting up the stabilized yield. Right, because the other thing people don't realize is your purchase price is such a big component of your stabilized yield. Right, let's say you bought a deal for $2 million, right? And you're going to renovate 10 units for 15K. Well, 10 units for 15K is only 150 grand, right? That's going on to your denominator, the stabilized yield. You already have that 2 million in there. The purchase price is such a big portion of that if you mess up the purchase price, there's almost nothing you can do to save the deal. And I think a lot of people don't understand that. They think that the operations of a multifamily building are more important or anything else is. It's not. The purchase price is such a big component that if you mess that up, you're done. So that's why I've always said I don't really worry about operations as much whatsoever, because let's say instead of 15K, it cost me 20K, like, okay, big whoop, right? It doesn't even add a big percentage to the stabilized yield because it's such a small component of it. But if you mess up the purchase price by 10%, you're done.
Yeah. So I was reading through some of your tweets, and this kind of touches on that. And you say here, people always ask you, how do you choose a market? And you respond, you don't choose a market based on statistical jargon. You actually start with, can I actually find a deal in this market? And I thought that was like very high level and just underappreciated by most people. The idea of getting that right purchase price in some markets, it's probably borderline impossible.
No, it's impossible. Then I don't understand this at all. People have this idea. They're like, oh, this market's so good. I'm like, can you actually find a deal in it and make money in it? And they're like, no.
So true.
What's the point? Like, what are we doing here? Right. So it's the point is to make money. And to even simplify it even further, if you can't find a market where you can stabilize above the market cap rate on a semi-consistent basis, you are completely wasting your time. And I have friends in LA or New York or wherever, and they're like, oh, this market's great. Like everything's going so well. I'm like, when's the last time you bought a deal? They're like 5 years ago. Okay, like you're not even a real estate investor anymore, you know? So it just makes no sense to me at all. And it's funny how the first thing people will look at when they look at a market is they're like, oh, the population growth is out of control. It's like, that doesn't even lead to you making money in real estate, right? Mathematically, you can still easily lose money if the population's growing, if the supply is growing more. So it's really stupid. And I think the framework needs to switch. I think in general, if you're a institutional private equity firm, yeah, sure. Start running data. You need the markets to increase. It's kind of like a rising tide lifts all boats type thing where they're betting on market rent growth, and they're equipped to do that. They have a ton of more data than you do. They have 100 analysts who are running the numbers too. They're gonna beat you at that game. But for an individual or a smaller investor, find a market where you can find deals.
Yeah, now let's touch on that a little bit, because Dan and I were talking before the show, and how far out of major centers, cities, whatever, like the LAs, New Yorks, all that, do you have to go to find a deal right now in your experience? Are we talking secondary markets, tertiary markets, or even further?
So, I mean, I think to some degree it's hard to kind of say that. I would say the first thing I look for is, can you find deals that pencil? Like if I could find them in New York, I would buy in New York, right? You typically can't. So I think the distinction between primary, secondary, and tertiary should almost go to, can I find a deal in this market or not, right? To answer your question more directly though, typically I think you need to be 3 to 5 hours outside of a major city to really start finding deals that pencil.
Yeah, so that's pretty far out. I think for the average investor, they'd be like, wow, 3 to 5 hours out. That's scary, because I don't know anything about that market is how people would think. So how do you overcome that small town-ish where you might not, they're not on the radar, you don't know much about them? How do you do your due diligence there?
Yeah, it's kind of funny because when you're in a smaller market, there's typically far less data. And I think a lot of people view that as a negative thing. Personally, I think it's a positive thing, right? And it's positive for 2 reasons. One, if the data is not readily available, that means once you do actually understand the market, you have an edge. The other thing is that it's not worth it for bigger firms to be in those markets because they can't get scale. So you have lower competition, and if you actually do the work, you have an edge. So generally, I find most people's aversion is they don't want to do the work, in which case you can't really help them anyway.
Mm-hmm. So doing the work, right? The data's hard to find. How do you get it? Are you boots on the ground? Is your what's your first step, I guess, to even find a market? Is it just looking at listings? Is it CoStar? Is it?
Yeah. So the first thing I do is basically, and this is what I tell anyone when they're looking at a market, is almost draw a circle around your location. And let's say it's an hour to start. and see if there's any markets in there where you find deals that pencil. And I would look at the markets for, I don't know, let's call it like a month, right? And do you find any deals where you're underwriting the stabilized yield above the market cap rate, right? And it doesn't need to be that much above it. Like, it doesn't need to be the normal 200 basis point spread you need for a deal, because you don't know the market that well yet. These are fully marketed deals. So if you find this in a fully marketed deal, imagine what there is on an off-market deal or a deal you get from a broker, right? So the spread doesn't need to be that big initially. It's just more of a vetting thing. But that's what I would do. And I would just draw larger and larger circles until you find one that hits. And I think people really overcomplicate it because they don't look at it from the perspective of, am I finding a deal in this market? They look at it from other perspectives. And I think when you look at it from that perspective, it's incredibly simple, right? You just keep doing it until you find a market that hits, and eventually you will. So that's how I would find a market. That's how I found my current markets even. So I really do think people complicate that aspect.
Interesting. You mentioned stabilized yield a couple times. You want to give like a quick example of what you're actually referring to for anybody listening? I don't want to get too technical and lose people throughout this. I want to make sure that everybody kind of gets a good idea of what you're referring to.
Sure. So let's say you're buying a deal, right? And the NOI is $50K and you're buying it for $1 million, right? Then there's closing costs of, let's call it $50K, right? So you're at 105. And you're going to put in $100K of renovations, and that's going to increase the NOI to $80K, right? So you have 80,000 divided by 1150, right? Which is a 6.95% stabilized yield. It's that simple. It's just basically the NOI divided by all your costs in the deal.
Got it.
That's a projection. You'd be projecting that we need X amount of renovations or input costs. Our rent is going to increase X amount. Our NOI is now Y, and divided by the cap rate, it's worth whatever.
Exactly. It's a projection, but at the same time, the numbers you're using shouldn't be a projection, right? Like, as in,
you're using accurate market data.
Yeah, the market rent shouldn't be something that you're projecting out in the future. It should be, this is the market rent today.
Yeah.
So yes, it is a projection, but in reality, it's a projection of this point in time.
Got it. 2 bedroom, 1 bath.
That's a big difference.
Yeah.
Yeah. Very interesting. What are you gonna say, Scotty?
Yeah, I was gonna say so these markets that are, let's say, 2, 3, 4 hours outside of the major cities, what size are they typically? Are we talking like small rural towns, or are they still relatively populous centers? Are there universities there? Are there big things, or is it kind of farm towns? That's because that's what I think, right? And that's probably wrong, but
yeah, I mean, I think it just depends, right? I bought in cities of 100K plus, and I bought in towns of 10 to 20K. So it really just depends. And I think people have this idea that they're going to go out to a market that has like no bid, and they're going to own an asset they can't sell. Look, maybe if you're in the middle of the Western US and there's just no one out there, sure, or some parts of the Southern US. But anytime you're near a coast, I think that's completely false. And I think in general, it's this day and age, there's almost always a bid for a decent asset, especially if you're on the multifamily side. So I think it's really pretty drastically overblown. And I was just selling an asset in a market with 10 to 20,000 population. I think we had like 15 bids, and that was during a pretty bad time to sell. So I think it's pretty much very overblown.
So you like to stick to kind of coastal cities, but borderline secondary, tertiary markets?
Usually, yeah. I mean, I don't think it matters if you're in a non-coastal spot as much. Well, all that's going to happen is the numbers are going to be a bit lower in terms of, obviously, the most expensive areas of the country are on the coast. But overall, it doesn't matter. There's probably even less competition in the middle of the country anyway. It's probably better.
Gotcha.
Now, do you care at all if you're in a market where it's stable, but there's essentially no growth and no future projection? Like, you can't see any reason why this particular town would be growing or not growing. It's just kind of stable. Is that what you look for, or does it have to be some level of growth? I
don't care at all if it's not growing. I care if it's declining, but not growing doesn't matter to me at all. The way I view real estate is you create your own value, right? Mm-hmm. So that's really, that part of it is up to you, right? You create your own value. I don't want the market to create value for me, because that ironically means you're guessing, right? What I want to do is be the opposite of guessing. I want it to be very certain that my numbers are correct. And I think it's funny how a lot of people are like, oh, I'm in a growing market, so it's better than your market. I'm like, not really. My numbers are based on reality. You're just betting that your number is going to go up. So you're actually taking way more risk than I am, even though you think you're not.
So true. That is
Yeah,
so true.
you're right. It is increased risk for sure.
Because if their numbers don't pan out, they're in a lot of trouble, right? If my numbers almost can't not pan out unless the market entirely collapses and the market rent goes to nothing.
It's very true.
Which is, never going to happen probably,
I mean, I would never say never, but the odds of the market rent cratering versus rent growth not happening are two very different things.
Mm-hmm.
It's what we're seeing right now. Rent growth is starting to fall off a little bit, right?
Yeah, and that's the thing. It's if you were in a sort of stable market and you underwrote correctly, you're beyond fine right now. If you went into a growth market, bet on growth, and it didn't happen, you're getting your loan called.
There you go.
I love these are such high level points, just changing even my perspective on a lot of stuff. I think a lot of the reason that Dan and I like following you, and just because we read your tweets and see what you're saying, and it's just like, yeah, like that's bang on. One of the things that's happening right now is, and this is one of your tweets as well, where people are still waiting for there to be blood in the streets. And you say, well, this isn't crypto. Prices are down 20 to 25%. That's like, how much more do you want for real estate, right? And the high level thought here is not trying to time the market, but one of the big hurdles that Dan and I always have to face when we're looking for investors is people thinking that they really can execute a market timing. So can we touch on that high level, just kind of the mentality stuff there? How do you deal with that personally? And what are your thoughts on market timing?
Yeah, I mean, to me, when someone says they're trying to time a bottom in the real estate market, it might be different for other markets. It just means to me they have no skill in the real estate market. Seriously, it just like if you're competent and you know what you're doing underwriting wise, the idea that you try to time the market instead of adding the value yourself and being certain of it just means you're incompetent. And I think a lot of people don't realize that they're kind of telling on themselves. But basically, they're saying the only way I can make money is if the market goes up. That's all they're saying, which means that you don't know how to invest in real estate.
100%. Or they require the market to hit bottom so that they buy in.
Which will not, it's not going to happen.
They view it as like a passive thing that goes up and down, which that's not how real estate works. And you talk to any good value add real estate investor, you do deals in any market. I mean, to give an example, right? I bought a deal in September 2021, right? It was probably the worst time in the last 15 years to buy a deal. It ended up being a 5X because I knew for a fact that it was going to be a good deal, even if rates went up, and rates went up 300 basis points during it. And I still made money, right? And not only made money, I had a great return. And the point of that isn't to talk about that deal. The point is that if you actually know what you're doing, the idea that timing the market is how you make your money in real estate is just laughable, right? Understand where the stabilized yield is of a deal you're underwriting. Understand the entire capitalization structure. Make sure you're not taking too much risk. And if you're stabilizing, for example, like if I find deals and I'm stabilizing to a 10 plus on multifamily, I'm buying that deal regardless of if the US like collapses, right? The market does not matter to me whatsoever. I don't care where the interest rates are. I'm going to buy those deals until I'm blue in the head, right? And the fact that people look at it differently has always been confusing to me because it almost makes no sense.
Well, it does. It makes sense because, like you said, they don't know what they're doing.
Yeah,
it's not really investors.
They pretty much view it like the public markets, where they think they're like it's a passive thing they're doing. Like it's like investing in the S&P. And a lot of the comments I got to that tweet were like, "Oh, the S&P is doing this." And it's like, I don't care at all what the S&P is doing. Like it does not matter to me whatsoever. The fact that you think me buying a 50-unit deal in Bumblefuck is going to be impacted by the S&P, it makes zero sense.
That's so true, man. Oh my God. Let me so I'm gonna start firing off some questions. I know you're not I know you're not a big advocate of macroeconomics and things like that. Tell us why not?
So I think first off, I don't think anyone has accurately predicted the macro environment of the last 5 years. Zero people, right? So that's the first thing. I don't think it's possible. And I think maybe every once in a while, someone gets really lucky on a big event and they hit it big and good for them. But if you're talking about a strategy to actually make you wealthy over a long period of time, that's nearly guaranteed. I don't think focusing on the macro is it. The second is I think we're kind of in an age of information, right? The problem used to be a lack of access to information. People had an edge over you because maybe they were born into a better family or maybe whatever, right? But now we have the internet. There's zero excuse for the lack of information. I could find anything I want. And I could become an expert on any topic in probably 6 months, right? And anyone else can if they want to as well. Every single possible piece of information you'd want is available on the internet. So at that point, right, the only thing that separates you is execution, right? Everyone has the information. Who's going to be the better at executing it? And I think macro is kind of, or being a macro investor is kind of indicative of this age of like passivity that I think is just over. Like everyone used to say, all right, you just stay at a job forever and you're good, right? You get your pension and you're fine. Put your money in a 401k. The S&P is going to go up forever. You'll be good. Like those strategies are all done, right? Every single person knows about them. Despite what people like to believe, you're competing against other people for wealth. And if everyone's already doing that strategy, you're done, right? It doesn't work anymore. So I think it's in an age of information, the only thing that matters is execution. And I think you need to go away from the passive macro side where like the market's going to make the money for me to the side of I'm going to make the money myself. And I think that's the biggest mindset switch that needs to happen. I don't think a lot of people have realized that yet, but I think almost all those passive type strategies are completely over and they're not going to work in the future.
Love that. Dan and I talk all the time, like kind of one of our quotes is people think they can predict this macro environment when there's actually no rules here. The Fed, the Federal Reserve, the governments around the world are moving the goalposts however they see fit. They can print money at will. They can adjust interest rates on a dime. You can't predict something that's unpredictable. But the amount of people like on Twitter and whatnot it's got to be 95% macro analysts just kind of parroting data points, but not ever really doing anything about it. And Dan, you've been on a couple calls where it's just people going back and forth, basically complaining about the macro environment, and nobody's ever saying, okay, how do we operate in this environment? What do we do to make money? How do we overcome whatever's happening?
Yeah. So what you're referring to is Twitter Spaces. So, Mike, like I've been in a couple Twitter Spaces where I got invited, and it's a lot of Canadian real estate bears that end up in these spaces, and all it is a bunch of complaining, and no one ever offers some sort of solution as to how to navigate this volatile or even quote unquote confusing market, and it's just everybody trying to predict what's going to happen, what they think is going to happen, how shitty it is, and it's like this hamster wheel that doesn't stop in this world whenever I get into these things, and I can't even be a part of them anymore. I can't even listen to it. It's like I feel like it's a bunch of kids complaining that someone's picking on them in a playground. Like it's really weird.
It's really, those things are really bizarre. I don't know how. I get asked all the time too. It's like, what do you think about the macro? It's like, first off, like, why are you outsourcing your thinking to me? Like, what do you think about it? And second of all, who cares, right? It just doesn't matter. Yeah. And the last thing is just the pure delusion of it. You have these people who have literally been wrong about every market turn for the last 5 years. Every single one they haven't called right. And you know that because if they'd called it right, they'd pretty much be a billionaire at this point. Yeah, and they've called every single one wrong. And they think like for some reason the next one they're going to call right. And just obviously you're not. It's not going to happen.
Another one of your tweets was people were clamoring, oh, when there's blood in the streets, I'm going to be buying, I'm going to be making moves. And then here we are. And like you predicted, nobody's making any moves. Right?
Zero people. Zero.
Yeah.
They're all like, oh, we're waiting for the extra like 50% drop down. That's not happening. I don't understand what these people like are thinking. I had one guy tell me that he was looking for like Citi stock to reach like 47 cents again. It's like, look, man, like that's like a once in a I don't even know what to call it. Like, it's like the people who saw the depression expecting another depression to happen, and it just never happened again for their lifetime. I think that's going to be the same thing with 08, where obviously we're going to have downturns, but people are going to lose so much money by anchoring to 08 as like the baseline. That's not the baseline, right? That was like an event that no one could have expected, came out of absolutely nowhere. And to expect that to happen again and to expect that to be your baseline is just insane, especially on the real estate side.
Couldn't agree more. People are always predicting the last of, cataclysmic event, but it already happened, and that's not what's likely to happen next time. And I think 08 brought a big change in how the Federal Reserve and governments around the world operate. They realized after 08, they can just bail out whoever and print money at will. So that's the problem. The game doesn't have any rules, which is what makes it impossible to predict.
Yeah, and I think in general, right, you had, especially on the real estate side, where people now are literally they expect like Class A buildings to be handed to them at like a 50% discount. That's not how it works. The way distress works, it's in the assets you don't want to buy. It's an office, right? There's a ton of distress in office right now if you want to buy it.
Oh, true.
No one wants to, but you can, right? And that's how it always works. It's never the best assets that are distressed. That doesn't happen. So I think everyone just has this. It almost feels like they watched like The Big Short, and they all think they're Michael Burry, and it's not going to happen.
That is so true. So you mentioned that the best assets are never going to be distressed for the most part. When we're talking about going into these secondary or tertiary markets, how do you end up picking the best assets in those types of markets? What depicts that classification for you?
Yeah, I mean, I think it's there's a few things that are involved with it, right? I think location is almost always the most important. I think a lot of people will talk about vintage too, in terms of the year it was built. Personally, I think a lot of that's, not going to call it overblown, but I think it's the wrong spot to focus on, right? I think someone would be like, oh, it's a 1960s build versus a 1980s build. And like the 1980s is obviously better. And well, who knows? It's been 50 years. Maybe the last owner spent a ton of time and was really careful on the 1960s asset. And the 1980s asset, they've just been like treating it like junk, right?
Yeah, really. It depends who builds it, right, too.
Exactly. It depends who built it. It depends on everything. And yeah, obviously on average, the 1980s asset's going to be better. But I think in general, it's almost all location based and kind of just the way it's built based, right? And this is more prevalent, I think, on kind of the office and industrial side and retail side than it is on the multi side, because I think multi is more of a commoditized product in general. But like the way the floor plans are laid out, the way the office, the windows are laid out, and all that definitely play a role. Overall, though, I think location and the way it's built are almost always the most important on the multifamily side.
Interesting. So what are some characteristics of a property that you're going into where you're underwriting, say, the submarket or the hyper location of that particular property? What are you looking for in its, I guess, in terms of amenities that it offers, surrounding area? What are you looking for?
Yeah, I think this is actually probably easiest to say on the office side because there's so many defining characteristics. But for example, on the office side, right, you would never want to buy a mid-block building. You always want a corner building, right? That eliminates almost so many office buildings, right? But basically, you think about having light on two sides versus light on one side. It's a massive difference to the tenants, right? So that's one thing. Next is ceiling heights, right? You usually want, I don't know, at least 14-foot plus ceiling heights. Then you'd be looking at kind of the core of the building. Where is it located? And like by the core, I mean like the elevator and the mechanicals, right? For example, let's say you have a building where it's located on the corner, right? You want the mechanicals in the corner, right? You don't want the mechanicals in the center where it's blocking everything. You want the mechanicals in the corner and stuff like that. You kind of overlook, but it makes a big difference. You'd also want floor to ceiling windows, right? Something like that makes a big difference in the tenant experience. You want no buildings nearby blocking it. You'd want no development nearby possible to happen. So hopefully it's a height restricted district where you're above the height limit. All things like that. There's obviously more you can rattle off. The floor plate matters a lot too. In certain markets, you want a bigger floor plate. In certain markets, you want a smaller floor plate. Depends on kind of the tenant base. And obviously you can do this for the multifamily side too. I think it's a little bit more boring on the multifamily side because I just find multifamily to be a way more commoditized product that I think in general, stuff like that matters less. Whereas there are some office buildings that are essentially no tenant's going to want to live in, right? You can have an office building, two on the same block where one's getting $100 a foot and one's getting 40. Whereas on the multifamily side, that rarely ever happens, right? Two buildings on the same block are pretty much getting maybe it's a slight difference in rent, but it's not going to be that different.
Interesting.
From a broader perspective, what is your take on office moving forward with the changes in the world?
So I think in general that it's really not worth touching until kind of work from home shakes itself out. And there are obviously situations where it can make sense. I was actually looking at a medical office building like a month ago and put a bid in and just lost out on that. But in general, like the downtown office, like until the risk reward kind of shakes itself out there, I think you're really not getting paid for the risk you're taking. And I'd have to look at the numbers because I haven't looked at a true downtown office building in probably a year or so at this point. But my guess is the risk reward isn't there yet. I'd probably want to stabilize to like a 12 plus to make sense of the work from home risk.
So staying on that narrative, I see a lot of, actually one of the last Twitter spaces that I was in, it was a bunch of people arguing about how all of this office in like Toronto and all these big cities are going to convert over into multifamily, and then it's just going to drive the cost of multifamily buildings into the ground. What's your take on that?
Yeah, like almost certainly not going to happen.
Almost certainly not going to happen.
Oh man, I don't know what the fuck some of these people are talking about sometimes, because like, you know, I've built a couple things, and you know, I've converted or I'm in the process of converting a small office to multi, and man, I almost regret doing it because it's so expensive. There's all kinds of these weird restrictions that it wasn't built for that. The infrastructure isn't there to support it. There's so many, and then you get, oh man, like people just haven't a fucking clue when they talk like that. It's so weird.
I think people think you just like slap a kitchen and bathroom in there and you're good to go. But no, I think in a lot of scenarios, it actually makes more sense to just build ground up at that point.
100%.
So yeah, I highly doubt it works that well. And I think a lot of those cities too, the city's going to be in trouble, right? Because that tax revenue is down so much, and they're really going to have to work with the developer, because in some cases there's going to be almost no bid for them, right? These buildings are just bleeding so much cash. Interesting.
Very interesting. I got some fun questions for you. So Scotty, you know the precious metal guy that we sat in on a podcast with? So he is extremely bearish, or you know, against touching real estate right now. He's a little bit more of like the cataclysmic type guy, and obviously he has a biased opinion about, you know, precious metals and Bitcoin and stuff like that. He actually sells them. What's your take on somebody that, you know, given the environment right now, given the fact that a lot of loans are coming due, and you know, the affordability of you know, essentially North America as a whole, and maybe even the world, you know, almost the world is coming to an end, or there's going to be a reckoning coming where, you know, these type of assets are going to be driven into the ground, and you're going to want to be in precious metals or Bitcoin, stuff like that. What's your take on that?
I mean, look, I'm not going to say don't have exposure to Bitcoin or precious metals. I think that's fine to do. But in general, this is almost back to the macro topic on real estate, but the whole idea of that don't touch real estate at all right now is just like, it just means you don't know what you're doing. It really doesn't. So like, just to give an example, right? Let's say, be generous and say the market cap rate is 8%. If you found a deal that stabilizes to a 12, right, you're essentially printing money, right? Because you have a 400 basis point spread, and you can capitalize on that spread, and we can go through the numbers and how that works. But you've essentially locked in your profit unless market rents drop off a cliff. So I think a lot of people are coming in from that perspective where they don't know what they're doing, and they think the only way to make money is the market going up. But in reality, to me, there's nothing safer in the world than stabilizing 400 basis points above the market cap rate, right? I would take that over Bitcoin any day. I would take that over stocks any day. I would take it over gold any day, because I know for a fact that that's where I'm stabilizing, right? And I'm creating the value. The market's not doing it for me, and I don't have to worry about anything else. So to me, I always found that funny. And I actually find it funny when a lot of people say that a value add deal is less safe than a stabilized deal on the same note, because a stabilized deal, let's say the market cap rate's 8%, you're stabilizing at an 8, that's actually pretty risky, right? Because if the market cap rate goes up, you actually start losing money. There's no execution risk, but you lose money. Meanwhile, if you stabilize at a 12 in a value add deal, and now you have 400 basis points of leeway. So I think in general, the way people look at the stuff makes no sense, right? If you're getting to a really big spread and the total magnitude of the stabilized yield is high, to say you wouldn't buy a deal right now just means you don't like making money.
So Drew, I'm going to guess that you know, the precious metal guy doesn't know real estate very well. I'm going to guess.
Yeah, for sure.
Dan and I always kind of joke, Mike, that I don't know one person that's gotten rich in the stock market or gold or Bitcoin. Personally, I don't know anybody, but I know dozens and dozens of people just in my social network that have gotten wealthy in real estate. And that's going to remain true probably until we die. You don't
like
typically
literally
these other asset classes.
I don't know one fucking person, not one. You know, I don't have all the, you know, we don't live in Manhattan or anything, but I don't know one fucking person that has gotten rich from the stock market or precious or like anything.
Yeah,
whatever. Like,
look,
not one.
I know people. Yeah, I think the stock market's great if you want to have a few million when you retire at 65. Like,
agreed.
That's great. Like, perfect. If that's what you want to do, go for it. Be my guest.
It's gonna take you 40 years, but
no, be my guest. You've done it. You know what I mean? But the
Well,
people who think that
sounds like Dave Ramsey right now.
yeah, just it's just not any sort of. And the other thing too is, and I think this is just so underrated, is if your strategy, right, your entire strategy investing in the S&P 500, you've learned zero skills over 40 years. Zero.
So true,
right?
Man.
Absolutely zero. Let's say the S&P goes through a period where it doesn't go up. Like, what are you you're just fucked? Like, just nothing happens. You just sit there like a baby and just pray. Like, I genuinely don't get it. Like, when you're investing in real estate, you're developing skills. At the very least, if say your deal goes really poorly, you have skills you could use the rest of your life, right?
So
you have a skill that no one else
all
has.
that stuff.
Everything, right?
One thing people
you invest in the S&P and it doesn't work out, you're literally fucked. You have no skills and you're just sitting there.
One thing people don't understand too, at a bit of a higher level with the S&P, is that I think historically, what is it, 7 to 10% the S&P returns over the 100-year period, something like that. What's interesting is that it kind of mirrors the M2 money supply of the US, which is basically an inflationary measure. So you're actually not really getting ahead of inflation all that much, if at all. If you adjust the returns to inflation, like true inflation, not the CPI.
See, but for CPI is what, 2% now? Yeah, it's definitely true.
Well, they say, right? But the inflation for the life that most people want to live is actually 7 or 8%. It's the rate of M2 money supply increase. So you're kind of, even if you have that couple million, by the time you get that couple million, your standard of living with 2 million is going to be so low that you never got ahead.
Yeah.
Really.
I mean, honestly, to me, it's as simple as this. Do you want to be in charge of your life or do you want to hope and pray? Right. And if you're in the hope and pray camp, cool. But that's not for me. Like, don't follow me on Twitter then, and feel free to just put your money in the stock market. But if you want to take
100%.
active control of your life, the idea that you just put it in a stock or the S&P, and yes, I know it goes up historically, blah, 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 and that's your entire plan, is insane to me. And I would never do that.
100%. So Mike, you mentioned, give us a quick walkthrough of, you mentioned when you have, say, for example, you're buying at a current 8% cap rate, you're stabilizing at a 12% cap rate. How do you typically go and create that 4% spread there? What are you doing in order to create that typically on a purchase?
So this is another funny thing. I mean, I would say the majority of what I'm doing is just bumping rents to market, and whether that means renovating the unit or just increasing the rent, it depends on the deal. Okay. I would say a lot of the time, especially when you're in these smaller markets, what people don't realize is the average owner is optimizing for cash flow, not for residual value, which is fine if you want to be a long-term holder. But if you plan on selling in a short time, it's actually taking away value from their building, right? And if you do something as simple as, let's say the market rents are $1,400, right? And instead of leasing it out to one of the first 5 tenants or prospective tenants who've used the property, you're willing to hold out for a month and incur that cash flow loss, but you get another $100 on the face rate. You just added an insane amount of value to your building. And almost no one's willing to do that for some absurd reason. But especially when cap rates are lower, like when I was a year or two ago, right, cap rates were 6.5%. You add $1,200 at a 6.5 cap. That's $18K in value you added per unit on your building, right? So one of the buildings I had was a 48-unit building. It added $900K in value just by waiting a little bit longer to lease up to tenants. So I think there's a lot of, obviously you have to renovate sometimes, but a lot of the times it's just not being an idiot on the operating side and understanding that the residual is worth way more than the cash flow. And if you optimize for the residual, you can usually hit higher numbers, and that's reflected in the capitalization people can get at acquisition when they're buying your property. It's reflected in their stabilized yield.
Interesting. So you're going in more so from a mismanagement perspective is more so what you're looking for in terms of creating that 400 basis point spread, more so than I guess
A gut job renovation.
cleaning up the units or whatever.
Yeah, the way I look at it is I would rate myself in the bottom quartile of operators. I don't think I'm good at operating real estate at all. I also don't think it's necessary to make money in real estate at all. I think it's actually the least important skill. So I'm fine with it. I'm fine with not being a great operator. And really what I do is I optimize for the acquisition, right? If you buy well, you crush it. And obviously this depends on the asset class. If you're doing something more like hospitality, you need to be a great operator. But if you're on the pure multifamily side, you don't need to be a great operator. I think it's pretty funny when people say their edge is operations on the multifamily side. It just means they have no edge. And they're like, oh, like my edge is operations. Like, okay, it's like, cool. Like, what are you outperforming someone by like 2%? It's the multifamily side. It's not difficult to operate a multifamily building.
Yeah.
So I don't really focus on that. What I focus on is buying well. And once you buy well, everything falls into place. If you buy poorly, then yeah, you're pretty much screwed.
Interesting. Very interesting. Scott, you got anything else?
Well, I love that distinction between cash flow and value actually added based on NOI and cap rate. It's so true. What do you own any buildings long term? Or are you just like a 1 to 5 year and get out at max value, or are there some things that you hold for cash flow?
It depends. Usually I'm looking at like a 3-year hold. Right now I'm holding a hotel that probably be a little bit more of a long-term hold just because there's so much to do on it. It's like a 15-acre property, getting event permits and stuff like that, which is like a year-long time horizon just to get, and then you have to implement the whole process. So it's probably a bit longer, but in general, I'm looking for a three-year hold or so. Honestly, even shorter on the multifamily side if I can swing it.
Wow, interesting.
Very Where's interesting. That hotel? What's the general vicinity feel? If that's not too personal.
General vicinity in terms of, is it close to where I am now? No.
Yeah. Okay. Well, hotel operations, is it? So that's probably just get it up to speed and sell, or you said you might actually hold that one.
It's really good real estate and it's on 15 acres, so there's a chance we hold it. There's a chance too if we're able to really execute on the wedding venue type side of it, that it cash flows so well that we'll probably hold it, because especially if you're more on the wedding venue side, the multiple gets a lot worse because it's more of an operating business and less a real estate business, in which case I'd be less enticed to sell. But there's a lot to see there. It's definitely a lot of work managing a hotel, and I can get into more if you want, but
no, I don't want to hear anything about it. I have a golf course, and I don't want to hear anything about it. Hospitality, man, man, the people are fucking tough. Honestly, they are so tough to deal with. I'm okay, Mike. I don't want to hear anything about it.
Yeah,
I'm having a good morning so far.
Really, the only reason I was willing to do it was because in a downside scenario, most of the rooms have kitchens and bathrooms. In a downside scenario, it still pencils as a multifamily investment. So it's actually pretty capped on the downside.
You got multiple outs there, it sounds like. So love that. And then Dan, you had a couple other questions, which, well, I guess we'll leave off on this. We know we can't predict macro. We know we can't predict the markets, but where do you see this rate cycle and market in general going over the next, let's call it 6 to 18 months?
I think there's going to be a ton of opportunity. I think all those loans are going to start coming due. And that's one thing that's not really a macro thing. That's like the physical loans actually coming due, and you need to do something about it. And whether maybe they can kind of tack on some pref equity and just kick it off and extend. If they can't do that, then they kind of need to come to market. Whether that's a attempted refinance, whether it's a capital call, whether they're just fire selling it, who knows? But I think there's going to be a lot of opportunity over that time. I also think at a certain point, right, it's not even about the real estate side. A lot of these people haven't been able to get liquidity on their assets for over a year now. And you give it another year, divorces happen, partnerships break up, people just need money for whatever. People are going to need to sell. And I'm starting to see it already. I think there's a ton of opportunity in the market. I just saw a deal, smaller deal, was under 5 units, but a true 10% plus stabilized yields with minimal execution risk. That barely ever happens. And that's starting to happen more often. So I think there's going to be an insane amount of opportunity.
Love that mentality. What do you see the Fed doing with rates, and where does this cycle end if you had to throw a dart?
If I had to absolutely throw a dart, I think it stays around this point, but it stays for a bit. I think everything's pretty overheated still. I think we're starting to see it. Anecdotally, just running businesses, having friends who run businesses, there's definitely a slowdown. But I have a hard time seeing them dropping rates within 6 months, a year. I don't know. I think some people expect that. That doesn't seem that likely to me.
Interesting.
Agreed.
Very cool, man. Very cool. Well, hey, Mike, get into what you offer here in your program. I know you offer a couple pretty interesting, you have a couple offerings here, and I wouldn't mind hearing about them.
Sure. Yeah. And basically what I'm offering right now is Acquisitions Bootcamp. It's an 8-week program. And the goal, there's kind of a few components to it. Basically the first part is to cater investment strategy around you, right? And I think, to take a step back, the way investing is taught right now is just completely wrong. I think it's pretty much like, hey, here's what Warren Buffett did in like 50 years ago. Look, here's how to do it. It's like, okay, but I'm not Warren Buffett. I have different risk profile, I have different goals, different everything, right? So the idea is to take all that into account, your skill set, your goals, your resources, all of that, and craft a strategy around you specifically that we can move forward with and start buying deals with. And that's the first step of the process. I do that before even teaching the real estate side, because I think if you don't have a goal, no one can help you anyway. So it's really about defining that goal. Then the next step is really teaching the real estate. And that's for 4 weeks, where it's every week focused on something different, but it goes through the underwriting, how to choose a market, how to close on a deal, everything really, really in depth. And working one-on-one with me. So there's a call with me at the end of each week to make sure you understand everything and to really chart a path forward. And then the last 4 weeks are all based on application, right? So we move from the theory to the application. You take the strategy that's built for you, you take the skill set you learned, and you're out in the market looking for deals, working with me to get you a deal. So I think it's really cool. I don't think anyone really offers anything like it. And we've had a ton of success so far. Ton of people buying deals. Just had a deal close in Oakland, $2 million industrial deal. People working on deals in Minnesota, 34-unit multi-deal, 12-unit deal in Colorado that should close in November. So there's a lot going on, and people are doing really well, stabilizing at 10% plus so far, actually, on all of them. So really great deals.
Very cool, man. Very cool. Might have to jump into that program, actually.
Yeah, seriously, like this is very informative. I could see this being very valuable to have somebody like you on their side. And then just to be clear, like are they out in their markets finding deals and then like kind of running them together with you, or are you sending them stuff, or how does that work?
So the idea is to just hand it off, right? I want them to not need me at all by the end of it. And obviously I still help through the process if they want it. But I'm trying to get them to the point where they don't need me whatsoever. So they're the ones looking for the deals. They're obviously running it by me, and like I'll take a look. I'll help them underwrite. I was working on PSA the other day. I was working on an industrial lease the other day. So happy to help with all that stuff. But yeah, I want them to be self-sufficient, right? And I think they want to be self-sufficient too. So that's the goal.
Very cool. Very cool. Well, awesome, man. Yeah. And why don't you let everybody know where they can follow you? I know you're not too big on social media, but you're pretty active on Twitter. And yeah, let everybody know where they can hit you up.
Yeah, it's at the Real Estate G6 on Twitter. Just the Real Estate God too, if you search it.
Must follow. Cool, it's a must follow for sure.
Yeah, very good info. Very good info. Appreciate it, Mike. Thank you so much for for coming on. And yeah, we'll talk to you.
Yeah, thanks for having me on, guys. Had a great time.
Thanks, Mike. It was awesome.
Awesome. Thanks, buddy.